Hi everyone, welcome again to another financial analysis video with myself, Moeed Amin, and my colleague, Ted Wainman. So if you're interested in upgrading your financial acumen and financial knowledge, this is the video and this is the channel for you. That is what we're here to do. We're here to educate you on how to become more financially savvy. So whether you are selling to a company or a sales professional, whether you are an investor, whether you are someone that just wants to actually grow in terms of a career, and understanding finance is a big part of that. This is the show for you. Today, we're going to be looking at WeWork. So WeWork, I don't think they need much of an introduction, but we'll give them one anyway for those of you that may not be familiar with them. So they are a co-working office space. You know, it used to be physical. They moved into virtual shared spaces as well with the COVID pandemic, headquartered in New York City. A lot of news about this business, right? So they became even more famous when SoftBank invested in the company. And since then, it's had pretty much a decline. So in November of 2019, SoftBank had to write off $8.2 billion in the valuation of the business, or the amount that they invested in that business. So that's a huge amount. And in Q1 of 2021, WeWork announced in their financials, they lost $2.1 billion, and 1 in 4 customers were lost as well. So there is a bit of a declining story happening here with this company. Now stick around, because we're going to be looking at the audited financials. So this is the annual report. And from what you learn in this video, you're going to learn how to look at these quarterly statements. So do stick around for that. We're also going to look at the share price, and you'll see some context behind that. But they floated in 2020, and since then, if you'd invested then, you'll be sitting on a loss of around 28%. So that gives you some context there. So without further ado, over to you, Ted. Let's share with our viewers what we found out about this business and what story the finances tell us.
Yeah, good to see you, Moeed. Thank you very much indeed. This video is, of course, at the request of one of our viewers. So Ashif Ansar here is for you. So just a reminder to all of our viewers, please do like, share, do subscribe. Really important you subscribe. Click the subscribe button and you'll get notification of any additional emails. And it helps us as well. You know, we like subscribers. It's good. It's good for us. It's good for you. So everyone benefits. So please do subscribe. And then if you'd like us to look at any other businesses, any companies you've come across kind of interesting in the news, then please do obviously drop us a line. And if you give us more information you give us, the more likely we are to look at the financials. So without further ado, we are going to jump into looking at WeWork's financials. And here we go. So they are available on their website under Investor Relations. If you are looking at that, you're going to be looking for the annual report, and it's called a 10K, and under the sort of the SEC, so the kind of the Securities and Exchange Commission. And this is a fairly long and detailed document. You'll see the table of contents in front of you right now, and we're going to be looking for the financial statements. So you can see kind of the financial statements is given to us on page 108. So this is a 734-page document. So if you suffer from insomnia, this is probably the document for you. But we're going to go and have a look at page 108 and see what the numbers are telling us. So here is page 108 with the financial statements. There's the balance sheet. We'll come back to the balance sheet in a minute. But what I want to do is to start off with the statement of operations, which is the income statement, the trading account, the profit and loss account. Now, this is quite a small quite small writing, so I think we'll just zoom in a little bit. So we're gonna lose, as a result of this kind of zooming in, we're gonna lose 2019, but I don't think that's too much the end of the world. So here we go. So hopefully you can see those numbers on your screen. What do we see? So first up, top line, here's the revenue. So we are dealing, you'll notice up here it says amounts in thousands. So we are dealing in dollars, in thousands of dollars. So turnover for these guys, $2.6 billion, $2.6 billion. And that is a massive drop on the previous year. It's a 25% drop. Now, we kind of expect that because kind of continuing pandemic. So we're comparing with 2020. In fact, if we just scroll a little bit across, we should be able to see 2019 and see what was going on in 2000. So 2019 was holding up, 2020 held up pretty well, and then 2021, the year ended 31st December 2021. That's when they really saw, you know, a lot of the kind of, you know, more of that sort of pandemic related falling in revenue. These guys, so the business model, you know, as I'm sure you're aware, they basically, you know, rent businesses on a long-term, rent buildings on a long-term contract, and then sublet them on short-term contracts. So they'll find an office block, they'll rent it for kind of 50 years, get a pretty low rent for that 50 years, probably not as long as 50 years, but maybe 25 years. And then what they'll do is they'll then sort of divide it all up, make it to a funky workspace, and then they'll rent out sort of individual desks to people, and they can, you know, they can basically charge more for each desk than it costs them to rent the building. That's kind of the business model. So what we see here is their location operating expenses. So this is kind of, you know, the cost of renting the location, and so there's our cost of sales. And what you notice actually is that the cost of sales is higher than the revenue they're getting, and that's a pretty consistent picture. The cost of sales is higher than the revenue. So I mean, they're trading at a loss. You know, the theory looks good on paper, but it's not actually working out. Now, my understanding, and I'm perfectly prepared to be proven wrong about this, is that our friend Adam, who is the CEO, is a big investor or a big owner of those properties. So when we look at these and we think, well, why are they paying so much and not being able to rent them out? And is there a little bit of a conflict of interest? And, you know, they're in the news for corporate governance problems. He's the kind of the CEO and the chairman, which means he's holding himself to account. And, you know, this certainly doesn't look like an arm's length transaction. So immediately, if I'm an investor and I see that these guys, they're renting the properties for 3 billion, renting them out, subletting them effectively for 2.6 billion, and the person they're renting them from is the CEO, I'm suddenly thinking, well, hold on a sec, that doesn't make sense, does it? I'm not sure I'd be investing in this. But anyway, that's kind of, I think, what's going on there. We got some pre-open location expenses. So that's kind of, jazzing it up and putting in the kind of the funky coffee machines and the bean bags and all that kind of stuff, etc., etc. The SG&A, selling general administrative expenses, and then they've kind of got all the other kind of costs associated with running the business, and there's the total expenses about 6.3 billion. So they are basically operating at a loss, a fairly substantial loss. Previous year 4.4 billion, this year 3.7 billion. They're paying some interest. There's the interest they're paying, which suggests that they've got debt, and that kind of makes sense because they'll have borrowed the money to rent the properties, or they'll be on a kind of on a lease, for example, and they'll be paying for the lease. And then there's a little bit of tax as well. But the bottom line is these guys are making a loss, and they're making pretty substantial losses. So 3.12 billion in the previous year, $4.4 billion this year. And I guess, as an investor, you've got to be thinking, well, I'd quite like them to turn the corner. I'd quite like them to get to be profitable. At what point will they be profit? So we'd be interested to look at the kind of, their forecast. When are they actually going to break even? When are they going to start making money? And how big does the business really have to be? Because, 2.6 billion is pretty sizable. 3.5 billion is also pretty sizable. So do they need to double it? Do they need to double again? Do they need to double again? Is this the way, the new way of working? And if so, have these guys got a kind of a monopoly on that business model, or are other companies are going to be adapting the way that they rent out their buildings? So summary, Moeed, I think the income statement's looking a bit messy, I have to admit. Nothing there that's kind of really exciting me. If we go to the balance sheet, here we can see the balance sheet. So we've got the assets up the top. So we'll notice, so big numbers here. Let's just we just try and divide it up because it's quite difficult. So this number here, this is the total current assets. So these are the things which we've got, which are either cash or going to become cash soon. You'll notice they're sitting on a reasonable amount of cash. In fact, let me just clear that. I'm just going to try and scroll out so that we can see the comparative to the previous year, which I think is important. So apologies if the numbers get a little bit small. If I can scroll out, which is a little bit, here we go. So if we can get to 2020 up there. So yeah, again, you know, the numbers are getting a little bit small now, so apologies for that. But hopefully we can see, you know, they've got about, you know, they got nearly $1 billion in cash, very similar to the previous year. They've got a few other bits and pieces, prepaid expenses, accounts receivable, etc., etc. Big numbers are really their property. So there's the property, and then the next is the lease right of use assets, which is basically another word for property. So they've got property they own and property that they are leasing. And then in terms of that sort of the lease obligations, which is effectively the kind of the mortgages that they've got, there we can see the kind of the lease obligations and the long-term lease obligations. So quite interesting that, you know, the property and the leases they've got sitting alongside that property, well, you know, the leases look, you know, like they're pretty high compared with that property figure. You know, there's not a lot of net asset in there, if that makes sense. So, you know, these are all on sort of, you know, 100% LTVs, to coin a phrase, loan to value. This debt here looks like it's funding the business, and you'll also notice that there was some convertible preferred stock. Well, that has been converted for this year, so that doesn't sit there anymore. So they got some debt. You know, basically this is just a ton of debt. This is just one massive leverage play as far as I can make out. And what you'll also notice, and it's a little bit difficult to see from here, but the liabilities, there's the liabilities, are bigger than the assets, and therefore these guys have what's known as a negative balance sheet. In the previous year, it was really, really big because this warranty down here is also a liability. So if you take 24 and add in this 7666, you end up with sort of 32 versus 25 on the assets. That's a big old negative equity. So it's not looking. This is not what I would call a healthy balance sheet. Let's put it like that. Down here we can see the equity and the total equity. So we're looking at this line here, and for this year, total equity negative 1.5 billion, which basically says that, you know, if you close the business down, you're going to be, you know, the shareholders are going to get nothing back, and the people who've lent the money are not going to get fully repaid. A little bit better than the previous year when all those warrant stock options were there, of a negative balance sheet, 7.7 billion. So it's going in the right direction. Accumulated deficit, this is the retained earnings. Obviously there is no retained earnings. It's, you know, they're making losses, and their losses are increasing, so that's kind of gone up. They're not paying out any dividends. Of course, they're not paying any dividends. They haven't got any money. And so what we see is, how do they survive? And we see this number here, and they basically are surviving. Part of that will be this conversion. You remember the warrants which were up here. The warrants would have been kind of converted into here. So that's not a cash flow aspect. It's just a kind of recategorization from debt to equity. But also they'll be raising money through the equity capital markets, which I think is interesting, because the question right now has got to be, how interested are you in continuing to prop up someone like WeWorks? So if we look at the cash flow statement, so that's the income statement. We've done that, and here's our movement in equity. The movement in equity, really nothing interesting to really talk about. I mean, we can look at it. It's you know, we're interested in this column here, Moeed, this one here, and this is the kind of, you know, how much they've lost basically. So at the beginning of 2018, they were sitting on losses of 3.3 billion. They lost another 3.3 billion, so they're now sitting on losses of 6.6 billion. We then scroll forward to 2019, and there is that loss of 6.6 billion from the end of last year. They make another loss of 3 billion, so now they've got a loss of 9.7 billion, and that 9.7 billion they then take forward to 2020, and you kind of know exactly what's coming next. Here's my accumulated deficit, 9.7 billion, really small writing here. There's the loss of 4.4 billion, so now they've got losses of 14 billion. So you know, is there a way out of this? I mean, I personally, I can't see, that there's nothing that's really kind of in the news saying we're completely turning the corner, we've changed the way we're operating, we're now going to be making profits. So here's the cash flows. And the line we're really concerned about here is this one here. This is the net cash flow from operating activities. You may remember, Moeed, and regular viewers will know that this is my favorite number, although of course you shouldn't have favorites, as I keep telling my 5 kids are all my favorite. But this is my favorite number because this is cash. You can't manipulate, or it's very difficult to manipulate this number. And this tells me, are you generating cash or are you losing cash? And these guys are losing 2 billion of cash. And you'll remember, Moeed, looking at the income, the balance sheet, we saw they had about just under 1 billion in the bank. And if you've got 1 billion in the bank and you're burning 2 billion a year, you're gonna have to do something in order to sort that out. And either you're gonna have to change your business model, or you're just gonna have to get profitable very quickly, or you're gonna have to go back cap in hand to your investors. And as we talk about with changes in the world today, jam tomorrow stocks falling out of favor, war in Ukraine, for example, inflation taking off. And inflation means we've got to put interest rates up, and interest rates going up means that property prices start to come down. And these guys own a lot of property, so there's a double play in there that suddenly you're thinking, do I really want to be betting, leverage bet on this property company, which is, going to see even, I kind of just think at some point, if I was an investor, and I'm not for full disclosure, but if I was investor, I'd be thinking I'm not going to be throwing good money after bad. That's my personal opinion, and I am frequently proved wrong, and I will be proved wrong again. So don't rely on my opinion. Here's the cash from investing. So you can see there's a little bit of investing going on. They are buying some property. $300 million is quite a lot, but it's not massive. Look at this. This is kind of $3.5 billion. They're kind of just building this portfolio. You can see that's been coming down because they're just like, we haven't got the cash. We're bleeding money on our existing properties. We haven't got the cash in order to actually fund acquisition. So if you do back this company, you're basically pouring money into a company that rents buildings for $5 and then rents them out for $4 type of thing, which is slightly crazy in my book. But hey, what do I know? Here is their the cash flow from financing. So if you remember, companies finance through debt and equity. So let's see what we got going on here. So we can see that there's so here we've got kind of proceeds from debt. So they are issuing debt, they're borrowing money in order to survive. There's a little bit of debt refinancing going on. That's these numbers here. We have got some interesting here. You've got these refunds these refunds of members servicing. So kind of it looks to me like there's quite a lot of members, which is what they would call their individuals. Members will invest in this company, or sorry, will deposit money with this company in order to be able to rent. It's like a deposit effectively, and then they get the deposits back again. I'm not sure why that's sitting in the financing activities, but hey, they've got a business combination. I have no idea what pipe financing is. It'll stand for something, and maybe one of our viewers will know and can type that into the comments. But the kind of basically net cash provided there, this number here, 2.3 billion net cash provided by financing activities is really, it's these two numbers together. It's this proceeds from business combination, whatever that is. But the point you're going to notice, Moeed, wasn't there last year, wasn't there the year before that. And guess what? It ain't going to be there next year. Okay, so that's a one-off. The debt, hey, you know what? If you're losing money, people are going to stop. I mean, they may lend to you, but they'll either charge you a very high rate of interest, or they'll just say, no, we're not going to lend to you. So I just kind of think that they do have this 9 billion in cash at the end of the year, but the only reason they've got that is that they're losing money on a daily basis, and that they are they're raising money from financing in order to try and plug those gaps. And at some point, I think they're going to go back to the market. And if I was the market, I would be saying no, thank you.
Just a note, there, 900 million, not 9 billion. Sorry.
Yeah, so 900 million. Yeah, that's my mistake. I'm getting overexcited with my millions and billions. So this number here, 934 million. So you're basically $1 billion. They got $1 billion in the bank, and you're burning 2 billion a year. Well, I mean, you can do the maths on that. Moeed, it doesn't take a rocket scientist. So let's have a look at their share price and see. So it's a recent flotation. It's bouncing around, and you can see that these guys, they really have, they've just taken a, if you're an investor, you've taken a big hit, and it looks like it's sort of come back a little bit. I don't know quite what's going up here. This like, oh, have we hit the bottom? But there's a phrase called a dead cat bounce, which is where a stock goes all the way down. People think, oh, it's the bottom. They bounce it all up, and then it just plummets all the way down and dies. I'm not necessarily saying that this stock is definitely going to die, but I'm just thinking that however low it goes, it can go lower. Okay, that it can keep going lower. It's still worth, and I put that in inverted commas, it is still worth nearly $5 billion. $5 billion market cap. And I guess the question is, Moeed, would you pay $5 billion for a company that is losing $4.4 billion a year, is burning $2 billion of cash every single year, and has a negative balance sheet? The net asset value of the business is negative 1.5 billion. So this is very jam tomorrow, and if you buy into the jam tomorrow, then good luck to you, and fill your boots. But quite frankly, I'm not sure that it's really something that kind of appeals to me. So there we go, Moeed. WeWork, not for the faint-hearted, and in this instance, I am definitely in the faint-hearted. It's not one for me.
Yeah, fair. And like I said to all our viewers, hashtag not financial advice. These are our opinions, of course. However, the purpose of these videos is to help raise your financial literacy, right? So you can make these informed decisions yourself. So great analysis there, Ted. Thank you for that. And as Ted mentioned earlier, about 98% of our videos come from you, the viewers, the companies that we analyze. You make the requests. So do leave a note in the comment section if there is a company that you would like us to analyze for whatever the reason is. Leave some context in there. The better the context, the more likely your video will be prioritized. And if you're a subscriber, you will receive notification the moment your video has been published. So until the next video, thank you, everyone. Thank you, Ted. We'll see you on the next analysis.
Good to see you, Moeed. Catch you later. So I hope you enjoyed that video and found it useful and informative. Now, if you want to know more about what I do, then you can visit Talk Financials and find out about the training workshops and the clients that I work with. And the QR code is on your screen right now. If you are interested in being able to do this yourself, to do some financial analysis, there's a couple of resources. There is an online workshop. It's available on my website, or you can click on the QR code and it'll take you straight through to this online workshop where you can learn to read and understand and interpret financial information yourself. Alternatively, there is a book available at all good bookstops, particularly a very big online one, and the QR code once again will take you through to the opportunity to buy the book, and there is also a Kindle edition. Otherwise, that's everything from me. Please don't forget to like, share and subscribe to the channel. More subscribers means that you're going to get notification about new videos coming up, and also the opportunity to ask questions, and do recommend any videos any companies that you'd like me to analyze for you. I think we've got a couple of suggested next videos coming up, so please do take the opportunity, have a look at the other videos, and don't forget to like, share and subscribe to the channel, and I will see you on the next video.